Well, there's a number of challenges facing mutual insurers, really all insurers today. The state of the economy, inflationary pressures, reinsurance capacity issues. We talked about this yesterday in our convention speech. What I call this four-headed monster. We say it's a new era of risk. There are a number of challenges facing the industry all at the same time. I think if you look back in the past, there's been times in history we've had coastal states that have homeowners insurance market problems, or you have problems in the New Jersey auto insurance market, or whatever the case might be. But the circumstances today are different. They're affecting virtually every carrier in every line of business, perhaps save the workers' compensation line. But everything else is really having struggles with all of these market factors kind of converging at the same time, creating challenges for the industry that are different and more real than some of the previous challenges we faced. I'm confident we'll get through it. The industry always does, but it is a set of circumstances at the moment that is unique and creating challenges for the industry really all around the country. Mutual industry is doing things they always do. The one thing about this industry is that it's what we call mature. They have been around, 60 some odd percent of the NAMIC members have been around in business for over 100 years. We have lots of companies that are over 200 years old. You think about all of the things in the course of human history that has happened in those times, inflation and wars and depressions and every other kind of event you can think of. Mutuals have always done what they always do. They figure out how to solve these problems. They're built for the long term. They take the long-term view of risk. They're very stable enterprises. And they're the picture really, they're an interesting dichotomy because most people think the mutual industry is this sleepy part of the industry that doesn't change. And I would tell you the only way they have been able to survive as long as they've survived is because they're really good at change. And they're going to change again here now. We see more convergence in the sense of we'll see more merger activity going on. There'll be more consolidations. Mutuals will also look at their underwriting and their rating and all those kinds of basic insurance 101 kinds of practices. And they'll make the changes they need to navigate these set of circumstances we're facing today. Yeah, on the legislative and regulatory front, there's a number of challenges. I would point to the need reform in certain states. We've got California has a set of circumstances that we really need to get our arms around when it comes to the wildfire risk there. California is not the most friendly place for legislative involvement from an insurance industry perspective, but we have areas there that we've got to get some reform made. I'm concerned about potential regulatory mischief as we look at new rating and underwriting technologies. This industry and consumers are demanding from the industry new ways to evaluate risk. We have to have the risk-based pricing tools available to the industry. This is much more than the old debate about the use of something like credit-based insurance scoring, for instance. It's a subset of that, but it's all the new technologies that are now available to member companies to more accurately price risk. They have to be able to use it, to be able to offer consumers what they want. And it's going to attract regulatory attention. All of the old skepticism about the industry is going to show itself from the regulatory community, from policymakers around the country. And I worry about how that debate is going to settle itself out. And then there's a discrete issue I am concerned about, and that's this most people may not even know about it, this proposed data collection exercise from the Federal Insurance Office, the FIO. It would be the first time the FIO goes out to the industry to try to collect data in a mass way. We're concerned about its authority. We're concerned about the ability for what kind of studies could be used on that data. And it's just not something that the FIO needs to be engaged in. And so we're working to try to push back on that one. But I could go on and on. There are lots of regulatory and legislative challenges facing the industry. But that whole topic, I think the most troubling thing is the whole risk-based pricing topic and all of its variations. Another issue set, but it's a trend as well, and that's just the whole environment around litigation abuse. We've got a problem in this country where insurers become the faceless entity that juries don't care about, and so you have these nuclear verdicts that you see around the country. You see new trends where we have litigation that is simply out of control. It's most of the time insurers win these cases. Most of the time their policy language is found to be clear, but you have to engage in all of the cost and all of the machinations of the litigation process. And so that trend continues, and it's one we're certainly looking at for the future. So we're obviously doing what we always do. We're out being the shield and the sword of the industry in legislative battles around the country. We're an advocacy organization first, but we also are looking at new ways to provide value to members. We have a new strategic plan that's got a number of new initiatives in it where we can find new ways to provide value to member companies. We're more active in the sort of compliance and judicial advocacy space than we have been in the past because we kind of have to be. But that's something that's new for us as well. And we've got some other things on the horizon that may be new value for member companies. In the data space, we may be able to offer some new data-related products to member companies that they've been asking us to provide, so I'm excited about that future as well.